Our next session will address the state of the carbon offset market. We've talked a lot about carbon markets and how they might help allocate capital to lower carbon parts of the economy and to lower carbon investments. We got a great panel ahead of us. Joe Paisley is going to be moderating and introducing the panel. Joe is the president of the GARP Risk Institute. Prior to having that position, Joe ran global stress testing at HSBC. So she's had experience in private business. She also ran supervisory stress testing at the Prudential Regulatory Authority in the UK prior to that. So she's been on both sides of that table and has enormous experience in that regard. And in the GARP Risk Institute focuses on all these issues and can't think of anyone better to moderate this panel. So Joe, please take it away and introduce our fantastic panelists today.
Thanks very much. I hope everybody can hear me. And yeah, thanks, Dick, for inviting me along today. It's been a very stimulating and interesting conference. Yeah, we do have a great panel, and we're going to be talking about the state of the carbon offset market, which carbon offsets have come up. I haven't listened to the whole conference, but they've come up time and time again because they're sort of critical for getting to net zero in the time, the urgency that we need to. So let me introduce our panelists first, and then we'll have introductory comments from them, and then we'll have some Q&A. And I do encourage the audience to submit questions into the Q&A box, because hopefully we can get a lively debate going. So we have Annette Nazareth, who's the co-chair of the Integrity Council for the Voluntary Carbon Markets, Eron Bloomgarden, founder and managing director of Climate and Forest Capital, LLC, and David Victor, professor of innovation and public policy at the School of Global Policy and Strategy at UC San Diego. And I'm sure that we're going to have a lively debate, because it is quite a contentious issue and there's many different perspectives. But one thing I would say up front is that we do have quite a long way to go to get these markets working appropriately. I think anybody who's looked at them in any detail would say it's a little bit of Wild West out there. So we'll talk about the state of it now and what we need to do to get the markets working appropriately to help us transition to net zero. So I think we're going to start with Annette, who's going to set out her perspective, and then we'll turn to Eron, and last but not least, David. So over to you, Annette.
Well, thanks so much, Joe, and thanks for this opportunity to talk about the work of the Integrity Council. I think you teed it up very well, which is that the current state of the markets is not where we want it to be. And certainly as a former regulator, as you know, I was a commissioner of the SEC. This is not what I'm used to seeing in terms of markets that are well-developed, deep, transparent, and have high integrity. So that's why I'm very excited about the work that we're doing. So the Integrity Council of the Voluntary Carbon Markets is an independent governance body that's been formed for the voluntary carbon market. We were established in September of last year to build on the foundations that were laid by a task force called the Task Force for Scaling the Voluntary Carbon Market. It was chaired by Bill Winters, and I was the operating lead of that organization. We had over 450 participants from all aspects of the ecosystem for the carbon market. So it was a very robust group. Our purpose of the Integrity Council is to ensure that the voluntary carbon market accelerates a just transition to 1.5 degrees. And we're going to do that by setting and enforcing definitive global threshold standards for the voluntary carbon markets, drawing on the best science and expertise available so that high quality carbon credits will channel finance towards genuine and additional greenhouse gas reductions and removals that go above and beyond what would otherwise be achieved and contribute to climate resilient development. We're built on world-leading and globally diverse expertise from across the carbon market value chain. We have an expert panel that's made up of 12 leading carbon market experts with very long-standing expertise in environmental and social integrity of the carbon markets. We're supported by a body of subject matter experts in topics ranging from things like carbon sequestration science to the rights of indigenous peoples and local communities. We also benefit from the strategic advice and insight of a body of distinguished advisors. And we have 30 such people on that board. And we also benefit from the insight of representatives of the IPLC community. We recently welcomed a managing director of the FSC Indigenous Foundation, Francisco Souza, and Hindo Ibrahim to our distinguished advisory group. We think that getting the views of indigenous peoples and local communities is absolutely essential to our work. So let me step back a second and say, what are we really doing on this Integrity Council? Well, our mandate has three parts. First, it's to establish, host, and curate these CCPs, these core carbon principles that I've mentioned, that delineate what is the threshold standard for determining what a high quality and high integrity carbon credit is, and what standards and methodology types may issue them. Second, we to provide governance and oversight over standard setting organizations on adherence to CCPs, as well as on market infrastructure and participant eligibility. And finally, to help coordinate and manage the interlinkages between individual bodies to define a roadmap for a responsible growth of the voluntary carbon market. As you know, there are a number of organizations involved in these efforts, and obviously coordination among them is absolutely essential. Our CCPs, as I said earlier, are high-level principles. They're going to be supported by an assessment framework, and that obviously is critical because we don't just need to have high-quality standards, but we need to ensure that they are actually implemented. And so that is what the assessment framework is about, ensuring that they, in fact, do what they're supposed to do. These CCPs are going to be subject to a public consultation, which we're hoping to launch sometime later in the second quarter of 2022, with a view to publishing our final core carbon principles and our assessment framework later in the third quarter. These are obviously critical to our mission, and we're hoping that through a very open, transparent, frankly, very regulatory-like process, we reach the best conclusions that we can, but it will be a very open, transparent process akin to notice and comment for rulemaking, and we very much would welcome input from all participants. As you mentioned earlier, Joe, it really is essential that we sort of up our game on the voluntary carbon markets. We need to ensure that they're rooted in integrity. You referred to some of the problems with the markets today, totally legitimate. There is greenwashing in these markets. It's not acceptable. If we don't improve these practices, it could really hold back the kind of progress that is so essential. So what does high integrity mean to us? One, it really means knowing that credits are doing what they're supposed to be doing, because there is a definitive global threshold standard that people can rely on that are the standard for high quality credits. It also means, and anyone who's been involved in the markets would know this, you need transparency, confidence in prices, because high quality credits are trading in a market that's based on rigorous standards and market infrastructure. And of course, it means as well that buyers are making legitimate claims, that they're using credits based on accepted standards. They're not they're not making claims based on transactions that really don't have integrity. And also that they're not using credits to the exclusion of truly reducing their own emissions as a first priority. So I guess I would say that our underlying premise is, if you build integrity, scale will follow. We think scale is very important in these markets to contribute to net zero, but we can only have scale if integrity is rooted as sort of the first principle. So we also think a powerful price signal will emerge if we have increased integrity, transparency, deep, liquid, standardized markets. Price signals are obviously critically important, and I know our other speakers will talk about that as well. And what we want to do is drive investment into high quality supply and accelerate climate resilient development, green growth, and large scale emissions reductions and removal. Again, as we said before, the voluntary carbon market today is far from perfect. It lacks widely accepted thresholds for high quality credits. As you know, it's a lot of reluctance on the part of many corporations who otherwise might be interested in participating in these markets to do so, because a lack of quality dampens their confidence. Again, as a former market regulator, I mean, you must have transparent, deep and liquid markets. You must have standardization so that you're channeling capital to its highest and best uses. And today we don't have common standards on legitimate use of credits. Now, at the Integrity Council, we're working on various parts of this. We're working on the supply side of the markets, where we're working on ensuring that we have strong, robust infrastructure, transparency, trying to build deep and liquid markets. The issue around the use of credits is being done by other organizations, such as BCMI, who we're working very closely with. So we are not taking credit for the entire part of this effort, but certainly important parts. We're also, frankly, trying to build a structure that, to the extent possible, sort of mimics a regulatory structure. And why is that? Well, because while we're in some ways self-regulatory, we're the voluntary part of the market, we don't have regulatory authority, but we think that the more closely we align with regulatory principles, the more, frankly, integrity and transparency we have, the more credibility we have. And ultimately, we're trying to build an infrastructure that, if at some point there's some appetite, and it would be fine with me if it gets sort of merged in to more compliance-based, government-regulated markets, all the better. We're not doing this to just create our own little infrastructure here. I think, to the extent that this is sort of modular and could actually work well with the regulated markets, and ultimately maybe is taken over by regulated markets, that's fine with us. So I think the more we build this in a way that can be scaled, that is consistent with regulated markets, that has the kind of transparency, credibility, depth of markets and integrity that mimics regulated markets that we're all used to, and securities, futures, derivatives markets, all the better. So that's where we are, and I'll end there for now, but very, very grateful that you gave me the opportunity to tell you about all of our current efforts.
Great, thanks so much. That's interesting. We might come into this potential merger later on. Eron, turn to you next for your perspectives.
Thanks so much, and just to congratulate Annette and the team at the Integrity Council. They're really doing such important work, and this is really such a fascinating market because it sits at this intersection of environment policy, voluntary corporate action, and sort of this emerging commodity market. And so this is a market that I've been involved in for about 20 years now. And so what I thought I would do is maybe just talk a little bit about the market itself, and then what we're doing, what the way I've been engaging through various different hats, and then also talk about maybe some lessons learned. But this is not, offsets are not a new concept. They've been around for at least 20 years. I was involved with the first offset project back in 2004, 2005 that received credits under the Kyoto Protocol CDM mechanism. So in many respects, we've got lots of history. We have lots of lessons learned. A lot of people are coming to this market for the first time, but there's a lot of infrastructure that's already been built. There's still a lot that needs to be done. So why are we talking about this? And why are we hearing about offset markets so much over the last, let's say, 18 to 24 months when they've been around for 20 years? There are a variety of reasons, but one of the main reasons is that there's a lot of pressure on corporates to take real and meaningful climate action. The voluntary carbon market, I don't know when the voluntary carbon standard was launched, but probably 10, 15 years ago. And corporate purchases of offsets was typically done as part of a PR campaign or a marketing campaign, a project that they could put on their brochure. That really, over the last 18 to 24 months, has changed. You still have that. Corporate, companies are still interested in that. But there's a lot of pressure now coming from lots of different forces that are working on companies. Annette talked about her experience at SEC. SEC just 2 weeks ago came out with climate disclosure guidance. The social license to operate for these companies is increasingly predicated on their ability to demonstrate real climate action. Other types of disclosure, potential future litigation, the ability to recruit and retain talent. The list goes on. And so I've characterized it really, over the last 12, 24 months as a wall of demand coming from corporates for offsets, because what they're doing is the companies are doing their climate strategies, and at least the ones that are the good actors are saying, look, we've got these hard to abate residual emissions that we can't, at least in the near term, reduce. So as a transition measure, and that's really what offsets need to be, we're going to purchase hopefully high quality, high integrity emission reduction credits. So maybe we'll talk for a minute about what I'm working on, and I wear a few different hats, but one is, in fact, we've just launched working with I have a firm called Climate Finance Partners, and working with a group called Crane Shares. Just this week, we launched an exchange-traded fund on the New York Stock Exchange that tracks, that's an offset strategy, right? That tracks CME offset contract. I think, as far as we know, it's the first offset ETF. So that's really interesting, bringing sort of this offset market into a traditional financial exchange. Another hat is I was the founder and I'm the CEO of a group called Emergent, which is a nonprofit, but we operate really as a commercial intermediary, and we've convened an initiative called LEAF, which stands for Lowering Emissions from Accelerating Forest Finance. The aim is to reduce deforestation, reverse deforestation globally. And what we do with LEAF is we work at a jurisdictional level, which means we work, offsets are created, or emission reduction credits are created by tropical forest countries that reduce deforestation. There's a standard called the Architecture for Red Transactions. If those reductions are verified, if and when the reductions are verified, Emergent will purchase the credits, and then we'll sell them on to companies on the other side. So we launched. We launched last year at the White House Climate Summit on Earth Day, and in Glasgow, we announced that we've mobilized commitments over $1 billion from now a growing list of companies. Now we've got 25 very large companies and 3 donor governments, which is the US, UK, and Norway. So that's a large commitment. To give you order of magnitude, the entire size of the voluntary carbon market last year was $1 billion. So, so $1 billion commitment in this space is quite significant. I mean, said that, we know to reverse deforestation, we need to go much larger. So we're going, we're aiming to 10, 20x that. And this, one of the points I want to make on the back of that is offsets are not, in voluntary carbon markets are not perfect, as Annette has said, but they hold promise to provide, a bridge as on the pathway to decarbonization for companies that are really on a credible path, while also solving some other major issues that we're facing, right? Like deforestation and protecting ecosystems. We know we cannot achieve the goals of the Paris Agreement without reversing deforestation. Even if we zero out hydrocarbon emissions or emissions now, we absolutely have to stop deforestation. It's 10 to 20% of greenhouse gas emissions is the destruction of forest. And so, we've got a double whammy. And then all of the other good things, so-called co-benefits around community, biodiversity benefits that you get, that you can achieve from investing in offsets. And so some of the lessons that we've learned and that we've applied to Emergent and Leaf are informed by the last 20 years of what we've seen in voluntary carbon markets. One of the key things observations that I'd like to point out is there's a lot of talk about making voluntary carbon markets and offsets into a commodity. And in many respects, they operate like a commodity, but in many respects, they don't. And the key difference is a lot of the infrastructure around commodity trading is around managing risk and managing delivery. You have that with voluntary carbon credits and offsets, but the key, really key is protecting the integrity of the impact on the ground. And I think the work that the Integrity Council is doing, this is really important, but this is really unlike just about any other commodity I can think of. You need to be able to track that there's real impact happening, real additional impact happening on the ground. And so, you need the standards, the verified carbon standard, or the architecture for red transactions. Another risk is windfall profits. How can the producer on the ground, the forest community, get $3 a ton, and there's the end buyer paying $30? Who's collecting that rent? That rent in the middle. Is it a trader in New York or London? So this is unlike other markets, because that really is a risk to the integrity of the whole operation. And then there's a real intersection with policy here, because what we're talking about is when we talk about offsets, you have a market operating over here, which is completely voluntary. I think it was Annette was referencing, which is corporate voluntary action. But offsets also are compliance tools. They're a different breed, right? We're not talking, they're a different asset. So California has been using, over the last 10 years, offsets that are verified to the Air Resources Board standards. And then beyond that, you also have the UNFCCC negotiation and the international framework that's still catching up with this. And we're all trying to figure out what is the intersection between kind of the UNFCCC, Paris Agreement, and this voluntary carbon market, and do they dovetail at some point? So a lot more to say on this, but let me stop here and really look forward to the conversation.
Great, thanks very much. Okay, so over to you, David, for your perspective.
Thank you very much, Joe, and terrific to follow Annette and Eron. I guess I have a little more pessimistic view about where we are in the markets right now. Probably not surprising, given the book that Danny Cullenmore and I wrote about the political economy of carbon pricing and some of the games that have been played there. But I guess the first thing I'll say, I'm going to say 3 things. The first thing I'll say is, we're the best of times and we're the worst of times on the offsets market. Why are we in the best of times? Because there's this huge demand, this wall of demand, as Eron said. you've got all of these companies and governments, it's mainly companies right now and nonprofits that have made net zero pledges of various types. They all say they're doing 1.5 degrees, they're consistent with 1.5 degrees. I don't know what product they're smoking and inhaling. They think they're consistent with 1.5 degrees because we're at 1.2 or 3 right now, and warming is accelerating. We're just going to blow through 1.5. We're going to probably blow through 2. So we should probably stop talking about temperature targets and start talking about net neutrality or emissions. That's something we actually control to a greater degree. I understand the kind of effort to benchmark this and to kind of pretend that the goals that everyone's talking about in diplomacy are serious goals, but they're not serious goals. They're goals that are unachievable, and they're agreeable only because they're agreed to collectively, not with any individual responsibility. So we have to level set ourselves in terms of kind of what's realistic. But nonetheless, efforts to reduce emissions, and they're taking the form of these net zero pledges. The net zero pledges out in the year 2050 are meaningless. The net zero pledges that have near-term targets, 2030 and so on, even planning targets, those are a big deal. So you've got all these organizations that are saying, okay, I wanted to keep the kids from chaining themselves to the front gate and being angry at me. And so to get them off the front gate, I had to say net zero. And so the kids left, but now what do I do? The kids are going to come back. And I think that's the problem that a lot of organizations are in. My university's got a net zero pledge by 2025. We have no clue how we're going to meet that. No idea whatsoever. And so we're doing all these things to reduce emissions, which is earnest effort, real effort, as Annette said. And then a lot of organizations are looking to the offsets market, and they're actually buying now because they expect prices to go up. And so you've seen transactional volumes and prices go up, and it looks like the best of all possible worlds and so on. So that's the kind of best scenario. I do a lot of work in the oil and gas industry, and those oil and gas companies, the ones that say they're doing something about climate, that's their game as well. Some of them are also reallocating capital and trying to figure out if they just go out of business in a zero carbon world, or they do something different that they're good at, and they're trying to figure that out. But if they want to be net zero, they're going to have to do a lot of offsets. And so there's this big offsets program, in particular offsets programs related to forests, so-called nature-based solutions, because it sounds really friendly if you call it a nature-based solution. The worst of times is that the quality problem that Annette was talking about. The quality problem is really, really hard. So you've got all these organizations that have come in that have said they're working on quality, or they're doing transactions that are quality transactions. And a lot of that is folks doing more monitoring, reporting, verification, MRV, around individual emissions, getting out to the 9th decimal place, an estimate for emissions, and kind of chipping away at that. You've got now methane projects, you've got satellite activities, you've got drones, you've got local measurements and so on. And if you're dealing with a facility that's in a regulated environment, then that's exactly what you want to be doing, because you need to know exactly what your emissions are against the regulated outcome. I'm involved with one company called Canary that does this. There's a bunch of other interesting companies. So that's exciting, but that's not really the problem. I think that we're focusing this Klieg light on measuring things precisely, and we don't have an answer for the real problem for quality and offsets, which is the baseline, right? Because the whole idea behind the offset is this is some effort that somebody made beyond what they were required to do in their regulatory scope. And so therefore we should give them a gold star, or give them a bag of cash more accurately, because they've done something beyond what they would have been required to do otherwise. And thus we have to be able to measure what would have happened otherwise. And for example, by volume, a lot of the projects are land-based projects. It's really hard to put a boundary around, what would have happened otherwise. In the compliance market, so not the voluntary market, but the compliance market in California, that's been done with average emission factors for soil carbon. What has that done? That's created this very strong incentive for companies that want to do projects to go off and bias their sampling into the places that are furthest off the average, because then you get the maximum number of credits. And so you get a bankable credit that's large in volume, even though you haven't actually done that much extra work against what would have happened otherwise. And you would also create perverse incentives, right? Because if you're getting a credit for doing something that you're not required to do, good Johnny, you went and did it, then Johnny organizes to make sure that he's never required to do anything. And so you have this really perverse incentive, which is to prevent the expansion of the regulatory system to cover the various activities for which you're getting offset credits, because the moment that system is expanded, then you can't get as large credits or any credits whatsoever. That's a fundamental problem. And so all of our quality discussions need to spend less time on the MRV side. And here's the picture of the drone that I'm flying, and more on how do I know that I've really solved the baseline problem. I happen to think that for most offset projects that are knife edge projects, they're kind of up to the edge and then you're doing something a little bit extra and you're getting a credit for that, that for most of those, the information asymmetries make the baseline problem essentially impossible to solve. But that's a debate. That's why Danny and I wrote in our book, and there's a whole chapter on offsets, why we said should not be using offsets, especially in these trading systems. So that's the first comment I want to make. The other two comments are briefer than that. First, the second comment I want to make is this is an interesting market for a lot of reasons. I mean, corruption is always interesting to study, but it's also an interesting market because the voluntary market, I think, is performing better than the compliance market. And that's hard to measure precisely, but the compliance market is so beset by Gresham's law and by regulators who are overseeing the compliance market who frankly don't know what they're doing. So they're setting all these protocols for formal offsets where you don't really know the baseline. You've got all these sampling problems that I mentioned, for example, in California, whereas the voluntary market has, for the most part, firms in it that want to do good, that know they're being held accountable beyond what the normal rules are. And so they're kind of trying to find ways to improve quality, all the kinds of things that Annette and Eron were talking about. And so I think we should be looking more to the voluntary market to solve the quality problems than the compliance markets. We should be wary about this becoming a regulated market too quickly because the regulated markets perform just atrociously. And we should be looking at the variation of experiences in the voluntary markets, in particular on the high price parts of the voluntary markets, which tend to be the higher quality parts of it. Because otherwise you get to this Gresham's law problem, and then you're back to basically a market full of garbage where everyone's pretending that they're doing something about the underlying problem. Third and last thing I'll say is about the solutions. The solutions are not easy because I think the counterfactual problem is unobservable. And the information asymmetries are nearly impossible to solve, as I said earlier, but again, that's a debatable proposition. One of the simplest solutions is to simply extend the scope of the regulated or price-based system that's governing the activities in the first place. So basically to not rely on offsets, but to rely on straight up price or regulatory incentives. And there's a whole debate about when and price, when regulation, what's the interaction between the two, in particular interaction between carbon tax systems and regulation, which is better than cap and trade systems and regulation. So that, but we need to rely less on the offsets market because of all of these perverse incentives. And that's led some of the firms that are the most committed to doing something like Stripe to set up buyers markets, to stop treating the offsets market as a place where you're going to get a quantity, a credit that you then can put on your balance, in effect, your balance sheet, to offset your emissions, but to say, here's a bunch of money, here's what I'm willing to pay. Let's have projects compete on quality for my cash. Now, in the particular fund that Stripe has been involved with, there's, I think, nearly $1 billion has been raised. There's a New York State program that was announced, I think, last week, some other programs, public sector programs. So you, in effect, invest in the technologies like direct air capture, that are super expensive right now, where you really know you're buying quality, but precisely because you really know you're buying quality, you're spending an arm and a leg for it. And so it's extremely expensive. And that is one way to kind of weaken some of the Gresham's law problems that we've seen in the offsets market right now. So I really look forward to the conversation. This is just a key topic for thinking about how market-based instruments work on the problem of climate. Oh, can I just mention, I just want to build on what Eron said, which is these are not new. We've been working on this in the climate space for a long time. We've been working on offsets for easily 40 years, maybe longer, right? Because remember, we have the bubbling program under the Clean Air Act, kind of a disaster. We have the lead program, we have the wetlands trading program. There was an offset market for red cockaded woodpeckers. So we've had some kind of experience with offsets of various types here and there. And where there's been a physical asset moving where you can solve the baseline problem, I think we've, but for transaction costs and so on, regulatory uncertainty, we've done okay. Problem here is that the baseline is invented by the project developer and by the policy environment, and that just is a license for mischief, I think.
I'm actually not surprised we haven't got any questions coming through, because I think the audience is probably going, oh my God, what do I make of this? I wouldn't mind just kind of going back.
If the audience doesn't know, then they should become offsets traders.
Well, exactly. I don't know. But anyway, I mean, I'm actually wondering where we should take the conversation, because there was just such a richness of views there. I do think the baseline point the counterfactual, if you like, is sort of critical in all of this. I wouldn't mind just unpicking that a little bit more, just so the audience kind of gets it, actually. I mean, David, maybe you could just explain how you would overcome that, or is it just impossible? Because, you know, and why it's so important, because I do think it's like a fundamental point. If we don't understand that, we can't really move forward.
Well, I think it may be possible to overcome some of the baseline problems with a truly independent assessment of a baseline, with conservative assumptions and on and on and on. But for all of the still information problems, if you're doing a forestry project, then you're in effect having an impact on the equilibrium value of land and the alternative use of the land and so on. So your baseline analysis has to somehow cover that entire scope, which seems kind of intractable. So that's why I've defaulted back to, I think the baseline problem may actually be harder to solve than we imagine. But I could imagine having independent groups work on baselines using conservative assumptions and then using that. The challenge, this has been particularly acute in the compliance market, not the voluntary market. The compliance market, the challenge has been that the only people who are off really doing the homework are the project developers, and the project developers and the brokers are steeped in strong incentives for corruption.
Yeah.
Maybe I can add to that. I mean, I think it is certainly it is a problem, and it has been a problem. One way, the way we've solved, insofar as we've tried to solve it, a few things. One is working at the jurisdictional approach, right? Because project developer, a lot of times what the project developer will do is they'll go into protected forest. We'll talk about forest projects that's under, right? Let's say maybe it's under threat, and they say we're protecting this, this, and it's hard to know, is this threat next year or is it in 20 years? The way we've dealt with this is we look at the whole, right? So the whole country or the whole state, and you say, what's the and the baseline that we use is historic benchmark, right? So you say, okay, because the goal is to get these countries or jurisdictions on a path to net zero deforestation, right? And we say, okay, what's the deforestation rate over the last 5 years? Let's do an average, and then that becomes the baseline minus deductions for leakage and uncertainty, and then that has to be recalculated every 5 years. So it ratchets down every 5 years, and the goal there is to get to zero deforestation, right? And a counterfactual by itself is not necessarily the problem, right? The problem, I agree with David, is where you have the project developers basically designing their own baseline. Because and also when you look at the policy overlay in the Paris Agreement, you have situations where you have projects in certain countries that are generating a lot of credits, yet you still have the country experience pretty deep deforestation. That, from a policy perspective and a Paris Agreement perspective, is not tenable. Right? We need to get but we use counterfactuals all the time to make investments, and so I don't think inherently using counterfactuals and creating baselines is a problem. I think it's doing it in a robust way. That another problem I think is the one-to-one nature, right? We're offsetting one credit, 1 ton for one additional emissions from the corporate. I think we need to move beyond that, because that creates an incentive to get to some level of precision that may be unattainable in terms of calculating the baseline, but also on the MRV side. I agree on this high quality. I just maybe push back on David to say that price doesn't necessarily always lead to higher quality. For direct air capture, for example, I think we're still a long ways away from that delivering at scale and at effective pricing, when there's a lot, if we're looking at effective capital deployment, we've got a lot to do on ecosystems and reversing deforestation and much lower cost mitigation that we urgently need, and that should be the priority for where we're deploying our money. And part of the idea here is use a market mechanism to figure out where we're going to allocate resources.
Yeah. Annette,
Can I just say one more thing we could do to help help with this, which is we could
Yeah.
have more systems that have buyer liability. Right now, almost all these markets operate with seller liability. So once the credit is monetized, the guys are gone. If we had more buyer liability, and there's going to be all kinds of complaints about transaction costs, so there would be a much more powerful incentive to actually figure out what works.
Right. So if I've bought an offset and it's
You're still on the hook.
reforestation and and the forest burns down, then it's my obligation to go and sort it out. Yeah. Annette, I mean, any perspective for you? I'd be interested in, like, what are the emerging norms in the voluntary markets that you're seeing?
Well, look, I think David has certainly described what are the parade of horrors in this market, and he's been involved in this market for a long time, and I'm sure has seen all the gamesmanship. I think what we're trying to do, again, with a group of expert, scientists who sort of believe they know what would really contribute meaningfully to getting to net zero through carbon credits, is what would a high integrity credit mean? And so we're sort of assuming away a lot of the games that occur today, and saying, you wouldn't be able to get credit unless you truly engaged in transactions that were additional. I mean, David talked about things where you get credit for for a nature-based forest project, and it doesn't do a thing, and they just you get credit, and then they go and move to the next plot of land and cut down those trees. I mean, that there's just so many practices like that it's not permanent. I mean, we need there are a number of attributes of a high quality carbon credit that today are not uniformly applied. And so what we're saying is you'd have to have a standard, and then that standard would have to be applied both at the project level and at the methodology level. And so there's quite a leap here. I mean, I also understand when David says, well, the best way to have a high integrity credit is put up the money and say put it up for auction, essentially, right? And say, okay, here I've got $1 million. Show me the best projects, and then you're the guys who'll get my money. That works at small scale. What we have today is a bilateral market, and even then it's not a market of high integrity. But to do this at scale, to do this in the amounts that we would need to really move the dial, would mean that you would have to do it, at a much greater volume. And to do that, what we have today, and I think Eron talked about, you've got corporations who, you're seeing more and more corporations who want to participate in this market, hopefully in many cases for the right reasons. I mean, it's not just because they get, credit in their advertising that they're seeking to achieve net zero, but that they actually think that's the right thing to do. But they're reluctant to do it if they don't have, confidence in the market. And frankly, at scale, there aren't enough people out there with expertise who they can hire to look at these projects and decide which ones have credibility and which don't. And so you can't have trading at scale if every contract has to be bilateral, and you have to have private negotiations and due diligence on every single project in order to ensure that it has integrity. So you really need to build a market infrastructure that's more akin to other markets that have high integrity, where that you can trade at scale. To me, the ideal would be on trading platforms where you bring buyers and sellers together, you build liquidity, you have better pricing signals, but there is a standard backing what is trading in that market that you have confidence is being applied. So you don't have to have some scientist on your staff doing the due diligence, you know when you go to that market and you buy a carbon credit that you're getting something that has value and that is meaningfully contributing to our net zero goals. So is that high ambition? Yes, it's high ambition. It has to be, because we are in this existential moment. We better have high ambition about how we're going to achieve our goals. And so we're trying to apply, the kinds of market structure, market infrastructure principles that apply in other markets, and are hoping that will, make a significant difference in what we have. And, the other thing, obviously, is this is only meant to supplement, but importantly supplement what goes on in the compliance markets, and importantly supplement what is our first and primary responsibility, which is all of us to reduce our greenhouse gas emissions to the full extent possible. I think Eron talked about that. This is sort of getting to that last mile. This is what we need to do until we do have better technologies and otherwise to to get us where we need to be. But the other benefit of having a market like this is that you really are bringing finance from the developed markets, where frankly we're the ones contributing to this mess, and to the developing markets, who are really do have a lot of these projects, and using the capital markets to finance those kinds of reduction and removal projects, but frankly also technology projects that could be so important to contribute to greenhouse gas removals. So that's my
you
story.
make some very powerful points there. Eron, I think you wanted to come in there.
Yeah, I thought maybe I think that was a great point. I maybe just for the audience, maybe just to clarify something on what Annette said, which is, we do have, there is infrastructure in the market. There are standards, there are verification bodies, there is third-party stakeholder reviews. I mean, this has been going on now for 20 plus years. I think the problem is actually we have too many of them because of the voluntary nature and the disaggregated nature of the market. We've had, we have the verified carbon standard. I mentioned the architecture for a transaction. We have the gold standard. We have the carbon action registry. We have compliance grade credit, CDM. There's been a proliferation of them. And I think part of the work, and I just want to clarify this so people understood, I think part of the critical work that the Integrity Council is doing is, for lack of a better word, creating a meta a set of principles to say, because not all of what's happened in each of those standards is necessarily good. And it may not always be malicious, to be honest, or fraudulent. It is also, this is has been an evolving space. There have been lessons learned. A lot of this has been learning by doing, and some things that may have been seem like a good idea, 10 years ago, are just not, considered a good idea any longer. So I think I just wanted to clarify that. And then on the other side of the market, and so for about 20 plus years, we've had these standards developing, CDM and VCS and now Integrity Council. One of the realizations I think that we've had in the development of Emergent and Leaf is, well, what about the other side of the market, the demand side? And you need to put criteria and standards and requirements on the companies and the buyers. And why? Because you want to make sure they're good climate actors and that they're doing everything they can do within their operations to decarbonize as quickly as economically feasible, and really only using offsets for their residual emissions, and only as a bridge. And so that is a new area of work that has not been really around for the last 20 years in the voluntary space, right? Because in the compliance space, obviously the offsets are used by entities that are facing a cap, so they're on a trajectory. So how do you do that in a voluntary space? How do you provide guidance to companies to have some confidence that they're on a real decarbonization pathway? And there's SBTI, Science-Based Target Initiative, that's been working on this, but that Annette mentioned VCMI, the Voluntary Carbon Markets Integrity Initiative, which is really looking at the other side of the market, the standardization on the buyers. Like, what does it take what are the thresholds to participate in this market?
Yeah, brilliant. I mean, I'd be interested to know whether you think there are limits to the scale of the voluntary market, and also whether you think that the flurry of net zero commitments is actually almost encouraging bad quality offsets. David, do you want to go first?
I'm happy to talk briefly about it. I see Richard has his hand up to ask a question as well. I mean, I think Annette put her finger on it, which is, can we get the scale of offsets implied by these goals with the quality at the same time? And I think so long as it's bilateral with bespoke projects, the answer's got to be no. But then that leads us down the direction where Eron's headed, which is maybe we need to have some more, integration of standards and less balkanization of the standard and so on. And that, my concern is just, we're running a bunch of experiments right now. We probably need to be more active in comparing the different systems and figuring out which are quality, which aren't quality, and so on. There's some of that going on. Maybe we could be doing more. There's been a big push right now, precisely because there's concern about volumes. There's been a big push to adopt single standards or limited number of standards. I think that's premature. I think if we don't know what we're doing, the last thing in the world we should do is push hard for single standards, commodify the whole thing, go to non-bilateral markets, and then you don't know what's good, what's bad. It's all seller liability. That seems like a recipe for, tulip mania. But I'm sure there's a range of views about that. That's, I think, goes to your point, Joe, which is, are the net zero targets, are they getting in the way? I think there's growing evidence that actually net zero is getting in the way, not because it's, a lot of companies that are trying to do good things. That's certainly true in many cases, maybe the majority of cases, but because it's creating this almost compliance-like incentive inside the firm where people say, I've now said I'm going to be net zero. Zero is a number that has this value. I got positive side on the ledger. I got to have a negative side on the ledger. Go find me something on the negative side of the ledger. And then next thing you know, people are just buying, anything that moves, but I guess doesn't move in the case of the offset, and claiming quality. And I think the market's not ready for that.
Yeah, no, absolutely. Dick, you've got your hand up.
I did. Some of this discussion reminds me of some of the bad behavior we've seen in financial markets in the past, where people take advantage of a trader's option by virtue of where they sit. They cash in their annual bonus, and then move on to the next thing, while somebody on both sides of the trade may be having a longer maturity problem that materializes only after that bonus has been cashed in. So what I'm wondering, whether you think the idea of having some vesting or collateralization of these instruments, in other words, a sort of fundamental change in the instruments, might change incentives and therefore change behavior in that regard.
So my view is that that's exactly right, and that it could be some combination of straight up full buyer liability or some combination of vesting where you adjust the terms based on the asymmetry of information, the potential for that kind of behavior. I think it's exactly the right way to think about it.
Yeah. Any other views?
I'm not sure. This is the first I've heard about somebody suggesting that the buyers should have liability. I find that a little difficult to take. But
well, market
I think
participants hate this idea that they
yeah,
talked
but
early on, and they said, "Oh, we hate this idea, so let's not."
Unless the buyers are really, part of the problem. I mean, I understand that they want to be able to say they're net zero, but normally it's not the buyer, it's the seller, the person who creates the product, who would have the liability. But the one of the things that Richard's question goes to, that some have talked about, one of the thoughts that I've heard is, could you have shorter term contracts that are like rolling contracts, right? So if at any point, there, as you know, Richard, there are ways to create financial products that could achieve some of these goals. Maybe one of them is that, you can have a product, or I'm just throwing this out, that is of a shorter term nature, but rolling. And so if it turns out that the product in fact is not permanent, or you find out it's not additional, can't roll. So now you don't have, that product anymore to claim your net zero. I mean, there probably are things that we could think about creatively that would get to
California, the California compliance market had used a version of buyer liability for their offsets. Basically what they did was, but it was only for fraud or major miscalculation in the verification. So
I can understand that complicit, but I mean, to just say this project isn't achieving its goals, therefore the buyer is liable for what?
I mean, that would destroy the market. I mean, that would, and also the effect it would have is it would eliminate the benefit to the project, right? Because the price that the buyer would be willing to pay would be so low as to no longer be interested, interesting to a project developer. So I see the point, but look, if I was a benevolent dictator of the world, what I would do is I would say, let's look for the highest and best use of offsets and try to solve large scale systemic problems. And to me now, where you can get the highest scale, highest quality, most co-benefits is solving deforestation. That's why that's sort of our strategy. And you can do that at scale at a jurisdictional level. You can be, you try to avoid the one-to-one because you can look at historic deforestation rates, which is a very good predictor of what the next year is going to look like. The challenge I think we have is there's so many different standards. There's so many different types of projects coming online. And it's up to buyers to sort of parse through. One of the challenges I find with the voluntary market is this is a different type of market in that there is a inherent societal policy decision that needs to be made, which is what are we giving credits to? What are we giving these offset credits to? In a compliance market, California makes that decision very intentionally. For example, they say they launched with 4 protocols and they say you can only get crediting for projects within the United States. And then they said, you know what, we want to provide more incentive for projects in California. So you can only 50% of your offsets can come from the rest of the US and 50% have to come from in-state California offsets. There are these policy decisions that inherently are very challenging to make in voluntary carbon markets, where you have that I think is a big challenge here. And I don't know if it's solvable through the Integrity Council or some other mechanism, but that's you have to recognize there's this sort of this policy decision. There's technical issues that need to be solved with the calculation of the baseline, et cetera. But we also have to recognize there's this really important, value decision that needs to be made.
We have about 4 minutes left. I'm just encouraging audience members to submit questions, but in that actually 3 minutes, in that remaining 3 minutes, I'll ask you to sum up. Are you more or less depressed than you were at the beginning of the panel?
Joe, there's a discussion in the chat that you might want to.
There is a discussion. I don't know if, it seems that this is all about the liability still, isn't it?
Right.
Yeah, I don't know if there's anything left to be said on that. I think the structure of incentives is absolutely critical, and that's got to be. But I don't know if there's anything more on that we need to cover here.
I guess all I would say, and maybe by way of, I don't know if I'm more depressed or less depressed. The good news is that we're focusing on this because you have more companies that really want to do something. They don't really know what to do, so they're trying to figure out how to make the numbers add up. So that's bravo. They're doing it in a system that's very easy to game. And the incentives are not set up really to reduce that, to what Dick was saying and so on. And I totally get why nobody who's actually in the market wants to do buyer liability as a kind of provision like that. I understand why that is. I also think it's revealing that if buyers actually had to track this, that their willingness to pay for these credits would approach zero. And I think that's not just a statement about all the transaction costs. It's also a statement about their confidence in the quality.
Yeah, no, that's very, very true. And Annette, how about you?
Wouldn't that be in any market though? Right. I mean,
no, buyers are liable for all kinds of things where they.
I think it would be typical of any unregulated Wild West bilateral market. And that's exactly what we're trying to address, right? We're trying to create a market that is much closer to a regulated market like a securities or derivatives or a futures market. And So, you know, maybe I'm sort of assuming the can opener, I hope not, but I think that if you do create markets that have the kinds of, you know, integrity, have the kinds of, you know, transparency and liquidity and the like, and where here, you know, as Erin said earlier, it's not just the market it trades on, but the underlying contract itself has to have integrity. That's the second step, right? So it has to be that the contract itself would have to meet particular standards. But if you do that, I can very much see that and certainly hope. So I'm still optimistic that you could see the ability to trade these kinds of contracts at scale in a way that could meaningfully contribute to our net zero goals.
Erin, last thoughts from you.
Yeah, I could say maybe it's you know, it's probably obvious that I'm positive towards offsets done the right way, and I see them as a key tool to driving climate mitigation and delivering co-benefits that are outside our the climate framework around biodiversity and people and et cetera. I think, you know, we've seen this before when you have, right, this is in the news, people are hearing about carbon, the price has been going, you know, is going up quickly. And so there's a whole sort of ecosystem of people who come in without necessarily the best intentions. We used to call them, and probably still do, carbon cowboys. And I think the challenge here with all the good that's going on is all it takes is you know, a few articles in the Guardian and the FT highlighting some bad actors that can really you know, cause a major step back in the market. And so I think the work that this panel, you know, David and Annette are doing and others is so critically important that we get this right and make sure that this integrity is key and can point to quickly the people who are the bad actors and they look, this is hive them off from the rest of the market.
Yep. Well, that sounds like a good place to end. I think we head back to you, Dick. Thanks very much. The panelists, a great discussion and a lot more work to do for sure.
Well, I couldn't agree more. And thank you, Joe, for moderating the panel. And thanks to Annette, David, and Erin for a fantastic discussion. Clearly, as we've said throughout the day, a lot more work to do. And we have some more work to do in our discussions today.